Hey, good morning. Good morning, everyone. How's everybody?
Good morning, Professor.
Good
Hey, good
morning.
morning, Angelica. Good morning, Naomi. Good morning, Carolys. Um, well, I have only three people responded. It seems like I have eight people currently in the collaborate. Um, However, only three people responded. Let me check. Let me quickly, but before I check the discussion board, let me share my screen so you can see what's going on. Alrighty, so let's see how many people are in the forum. So I have six people in the forum, and I have only, that's not, I have nine people actually, nine people in the collaborate. That means three people in the collaborate haven't reported attendance in the discussion board. Okay? Please let me remind you that the first order of business is to report attendance in the discussion board. Okay? So the first place that you must go to is the discussion board, not the collaborate. First, go to the it's just like in a physical class, in a physical in-person class, you walk into the classroom and you sign into the sign-in sheet, right? If it depends on the professor. Some professors don't have sign-in sheet. They just do the roll call. But some professors have sign-in sheet. I don't have time for the roll call, so I have the sign-in sheet. The sign-in sheet is the discussion board, right? Today's forum. So please go to today's forum. If you haven't done it yet, please report attendance. Mahid, your microphone doesn't work in the collaborate. Um, I think it's the, I don't know, there must be a way to adjust your microphone volume. For example, on the bottom of your screen, right? See, don't you see, this is called taskbar. In the taskbar, don't you see the microphone icon? Huh? I don't know if you have, I don't use Apple, okay? Uh, um, I don't like Apple computer. I mean, I like the company Apple as an investment uh, instrument or investment target. I'm an Apple shareholder, but I don't like Apple products. You might say that's very contradictory. Because to me, people say Apple is more intuitive, blah blah blah. That was when that was the time when when Macintosh came out. Macintosh was more because it had user interface. Um, with a graphic user interface, it was obviously more user friendly. I mean, more intuitive. But now everyone, it's all Windows. Since 1995, we have all so I don't think Apple has any more advantage. But anyway, if you check your Mahid, can you hear me? Do you hear me? Check your microphone status. Look at the taskbar. I don't know if you have Apple computer or not, but if it uh, okay, but on Mac you must have something. You must have the taskbar like that, and then got to go into the microphone and adjust the setting. And there's nothing I can do from my end. You gotta, it's your computer. You'll have to check your setting. Get some help from the help desk, BMCC, help desk. Uh, um, or e-learning. Other than that, I don't know what to say to you. Now, so I see 10 people. There's an anonymous caller, so I'm sure someone is connecting through the phone. So anonymous caller, who are you? Who is the anonymous caller? Anonymous, can you hear me? Your microphone is on. Hmm. Whoever you are, I want to see these 10 people, exactly those 10 people here in the this today's forum. Yeah, I have exactly 10 people. Okay, so now let's go to in our last class, we uh, we wrapped up everything about the geometric average, right? Annualized return. So now we are moving on to the interest rate. And why do we talk about interest rate at this point? Well, because interest rate is I'm talking about the bank interest rate, first of all. I mean, interest rate doesn't only mean bank interest rate, but the bottom line of all interest rates is the bank interest rate. And then the reason we are talking about interest rate is because interest rate is uh, the most basic return on your money, right? Isn't that right? It's the most basic return on your money. And if you think about it, you don't consider bank interest rate as return on investment because you never consider putting your money in the bank as an investment. You probably don't. But if you think about it, actually, it's the most riskless form of investment. Isn't it right? Um, because it's riskless because the money you put in the bank, you will always get it back. And the interest you get back, you get the interest too. Of course, the banks can go bankrupt too, but then um, it hardly happens, since the great market crash of 1929. Uh, it hardly happens because there is FDIC, Federal Deposit Insurance Corporation. So FDIC is basically the insurance policy for the commercial banks. So your deposit and all the commercial banks are basically FDIC member. I mean, think about it. There can be no bank, commercial bank, um, without affiliation, without membership in FDIC, because who's going to knowingly, who is going to put their money into a bank that doesn't have FDIC membership? Uh, that means um, you are getting a rental car. You're renting a car without any insurance, right? That's like um, so. And uh, the rental car without any insurance will have less chance of getting rented out. I mean, in other words, the same thing, same logic. Uh, the bank that doesn't have FDIC coverage will have less chance of getting uh, doing business, getting deposit from the customers, because as knowingly, who's going to put the money there, right? Knowing that they are not FDIC guaranteed. So think about it. So the interest rate is the most basic form of return on the money, because there is no risk involved in putting your money in the bank. And your money, as long as there's FDIC, your deposit is guaranteed up to $250,000. Okay, that means even if the bank fails, the FDIC insurance will pay you up to 250,000, right? So, um, uh, and interesting thing is, if you put your money in the bank today, and of course, I'm talking about the savings account because the checking accounts don't pay any interest. Okay, um, there was a time when some checking accounts also paid interest, but that was, when the interest rate was very high. These days, the benchmark interest rate, um, most, benchmark interest rate for every bank interest rate, which is, called Fed funds rate. Benchmark interest rate is, basically 0%. It's basically between 0 and 0.25. It's not a fixed number. It's got a range, and the benchmark interest rate is between 0 and 0.25%. So, um, actually, if you have a savings account, you would know what is the interest rate on the savings account. Can anybody tell me what your if you have a savings account? Can anybody tell me what you get on your what kind of interest rate you get on your savings account? Can anybody tell me? Anyone?
Right now it's really low. It's like 0.5%, I think is the highest.
Did you say 0.5%?
0.5, yes.
Yeah, and was it whom? Kathleen,
Yes, Kathleen.
who said that? Yeah, Kathleen. Yeah, I'll give you 0.25 point for that. Uh, yeah, it's actually, if it is zero point 0.5, it's still very good for a savings account. Um, it would be like, not even 0.1%. It's not even 0.1%. That would be the going rate for savings. And zero point 0.5 would be something like the rate on CD, right? If a certificate of deposit. And what's a CD? CD is a contract. It's a savings account basically. CD is a type of savings account, but unlike the regular savings account, CD is a contractual agreement. It's a contract. So, meaning, it's a binding contract. And if you put your money, let's say you put $10,000 in the CD, and because it's a lending contract, it's basically, uh, you're basically lending to the bank for a fixed period of like 1 year or 2 years. Okay, so it's a lending contract. Since you entered a contract with the bank, uh, that means you cannot withdraw money before maturity, right? If you withdraw money before the maturity, that's a breach of contract. And for every breach of contract, there is penalty. I mean, early termination fee. I mean, even the phone, right? Mobile phones, you get into a contract. I mean, the contract is no longer like, a contract in the early 2000. In the early 2000, it was really a 2 year contract. They basically lock you up in 2 year contract. And it's understandable, I mean, everybody can understand the reasoning behind it. Why contract? Because they want to have like a steady, flow of, income, cash flow for them, steady cash flow. Otherwise, they will have difficulty, providing, stable service. But anyway, the idea is. A regular savings account, you can put your money in there, and then you can, withdraw money, anytime. But then savings account, the bank doesn't like it if you make frequent withdrawals, right? And also, it's not difficult to understand the reasoning behind it. because savings account is basically, the source of, funds that the banks can use to lend, right? Makes sense? Um, the main business of banking, if you, the main business of banking, uh, uh, the main business of banking is in what? Main business of banking uh, is to somebody dropped something in the chat box. Yeah, if you take out 6 times in a month, the bank will charge you. Yeah, yeah. It depends on, it varies from, bank to bank. It varies from bank to bank. Some banks have more strict, policy. Some banks have more, loose policy. Some banks, allow only up to 2 withdrawals. But the reasoning behind it, it's quite obvious. You all understand. Because it's the balance in the savings account is the source for lending. And the main business of banking is in lending, right? Think about it. Banks make money by lending money, right? Banks don't make money by taking deposit because by taking deposit, if they take deposit, they have to pay out interest to you, right? So they must make that interest somewhere. I mean, they must make that interest. If they pay out interest to you, then they must make that interest somewhere, right? To pay it out to you, and they must make more interest than that they pay out to you, right? Makes sense. Um, so and the source of so the interest they make is from lending. By lending money, they make interest, right? They charge interest, so they make money, and from that they pay out interest to you. And of course, that means if they pay out 0.5% on your savings, again, in reality, it's like 0.1%. 0.5 they CDs, some CDs pay 0.5 these days. So this is ridiculous because even in early 2000s, some CDs paid even up to 6% a year, 6%. Some CDs paid 6%. And even a couple of years ago, like 2019, 2018, 18 through 19, you could find some banks, some CDs that paid about 3%, 2.75 to 3%. That's still compared to, early 2000s, 6% interest on CD. Compared to that, this is, ridiculous. Still, not a good thing. It's only half. But, 0.5% on CD, this is ridiculous. But, why is it like that? If you look at see, all interest rates are basically tied to the benchmark interest rate, and the benchmark interest rate is called Fed funds rate, which is, federal funds, short for federal funds market rate. And let's take a look at the trend of the federal funds market rate, Fed funds rate. So this was, January 2006. Fed funds rate was around, 4.25, and then July of 2006, it went to like 5.25. So 1% over 6 month period, it went up 1%. But actually, starting from like 2000. Starting from like 2005, it went up almost, like 4% from, why? Because in the early 2000s, the benchmark interest rates were very low, relatively low, not very low. Why? It was like 1.25, 1 point. So from 1.25 to 4.25, and uh, 2007, right? To July of 2006. Now, think about it, from July of 2005 and July of 2006, over 1 year period, it went up by almost by 3%. I mean, 4%, because it was like 1.25 and 5.25. So over just 1 year period, like 4% increase in benchmark interest rate. That is just drastic. That's crazy, Uh, but that's what caused the housing market crash in 2007. Such a high interest rate. And then, but early 2000s, like 2000 through 2005, interest rate was relatively low. Um, and then it was, at 5.25 until like January 2008, and then drastically dropped over just 1 year. It dropped 5% to 0.25, and it was held at that level until January of 2016, and it went up slightly to zero point 0.5 in January after January of 2016, and then it was held. Uh, and then think about it, and after that until like December 2018, um, the Fed funds rate was somewhere between 2.25 and 2.5, and during this time the CDs were paying something like 2.75, and the best one was even paying 3%. So you can tell the interest rate is basically based on or tied together with the Fed funds rate. That's the short-term interest rate. Long-term interest rate is tied to 10-year Treasury note yield on 10-year Treasury note. But I'm going to get to that later. So that is the reason why. And then after that since this COVID pandemic crisis, so that's from early 2020, then the rates went down again to like 0 to 0.25. Okay, so that's why we are seeing such low interest rates these days. And why does the interest rate have to be low? Um, Interest rates must be lower to stimulate the economy when the economy is depressed. Okay, um, but is the economy depressed now? No, actually the economy is doing very well. Uh, there is, you may have heard, the news that if you've been, following the economic news, would uh, you must have read from the New York Times or Wall Street Journal, or heard from CNN News, or whatever, Bloomberg News. The wages are rising. Wages are rising. Why? Because there are too many job openings, but not enough people to work, not enough people to fill those openings. So that means if there are too many job openings, what does that mean? Businesses are booming. Business need to hire people, right? But then they don't have uh, uh, skilled workers. They don't have people. Uh, so has anybody heard that news? Has anybody read that somewhere? I'm sure it's not only me. You must have.
Yes.
Yeah. Who said yes? Yeah, Angelica. Yeah, at least you
Yeah.
are following the news, right, Angelica?
Yeah.
Yeah. Anybody else? Huh?
Hi, I'm Jody and Harry. Yes, I did hear that as well. I think one of the fast food chains, I think it's McDonald's, wanted to pay a part of the tuition for people who worked there.
Yeah, I mean they are even providing incentives, to hire workers. I mean to entice the people to work. They are even they are even putting up the $1,000 sign-up bonus. Right? Have you heard about that? So yeah, this is the, then obviously the economy is booming, not, really, uh, and it's only because, I mean, at the onset of the pandemic, the economy uh, uh, dipped. The economy went down a little, but then thanks to the stimulus, package, economy didn't, go into recession. Uh, and the low interest rate, thanks to the low interest rate, and you might scratch your head. Why is low interest rate? I mean, uh, doesn't low interest rate, sound like a bad thing? Because um, if the, I mean, why would I put my money in the bank if interest rate is low? But yeah, that's exactly the point. That's exactly the point. I wouldn't put my money, I wouldn't keep my money in the bank when interest rate is not so low that it's not even catching up with the inflation, right? Um, then where would I put my money? Well, I would put my money somewhere else, right? That earns more return than the bank interest rate. So where would I put my money? Then I would put my money in stocks, right? Of course, stocks don't guarantee that you will get, always, big return, but on average, stocks give you a higher return than the bank interest rate. And it must be, the return should be at least, good enough to more than cover for the inflation. Because if inflation is 3%, and if my return is, 2%, not even, my return is even 1%, then my interest rate is 1%. I don't, I actually lose money because, because of inflation. I'm not even, uh, my purchasing power of my money will not even catch up with the inflation. So think about it. The idea is, um, uh, there is certainly, you can tell there is an inverse relationship between the economy and interest rate. You understand? Inverse relationship. So high interest, that means low interest rate is good for the economy. Low interest rate stimulates the economy or fuels the economy, whereas a high interest rate is cooling off the economy. Then you might wonder, what? Um, as I said, that sounds like a bad news if you are a saver, isn't it right? As long as you have your money in the bank. Yeah, I have, I do have a decent amount of money in the bank savings account, uh, but that money is idling. But I just keep it there, because just for liquidity, just in case I need some, cash. Uh, but if I don't need, I would just keep only just small amount, not small, just about right amount uh, of my money in the savings account and put the rest in the stocks. But I would also have some in even in my investment account. I would keep I would keep at least 30 to 40% of that in just in cash, not really invested. I would say 30%, because at least even if the stock market goes down, I can still I don't what I keep in cash, one I don't lose it. I don't It won't go down. Um, but now here, an important thing is, there's an inverse relationship between the interest rate and the economic growth. And the second thing is, as I said, so has the interest rate been this low all the time? No, I told you. As I said, there was a time when bank interest rate was very high, and even early 2000s, I told you the bank interest rate was at least, I mean, on CDs you could get at least, something like 3%, or if good, 6%. But actually, that was, early 2000s was the period when interest rate was still very low, like, a 1.25. Benchmark rate was 1.25. But, back in 1980s, early 1980s, 1980 through 1985, the benchmark interest rate was as high as 15%. 15%. Can you imagine that? That means, CDs, or, in a savings account, if you put your money in the savings account in those days, you could earn anywhere between, 10 to 15% in those days, right? Well, that's a huge return, historically, there was never a time when interest rate was that high. But then what did I tell you? There's an inverse relation. You might think, oh, that must have been a great time. No, it wasn't a great time. It was a great time for savers, but it wasn't a great time for the economy, right? Why? I told you there's an inverse relationship between the interest rate and the economy. So that means, you can tell early 1980s, then there must have been a recession. The economy been very bad. Yes. Yes. As a matter of fact, early 80s, there was a period of a recession. But why? Then, I mean, why did they keep the interest rate that high? I mean, if the economy was in recession, then why didn't they try to lower the interest rate and get out of recession? Actually, it was a Federal Reserve induced recession. Federal Reserve induced deliberately, intentionally induced that recession. Why? Because the late 70s, like between 1975 through 79, it was a period, second half of 1970s was a period of a high inflation, very high inflation. And it was a high inflation plus, stagnation. It was called stagflation. Economy, what high inflation means, economy was overheated. Economy was too good. It was overheated. But then if economy was too good, what's the problem? I mean, wasn't it? I said too good. That means, economy if economy is good, that means economy is growing, and low interest rate takes the credit for that. Economy is growing, but when the economy is overheated, it's growing. At the end of this fast growth, the economy will inevitably run into the wall, because the physical side of the economy, physical growth of the economy cannot expand. Physical growth of the economy cannot expand at the same fast rate as the inflation. When economy keeps growing at a fast rate, then it will hit the physical limit of growth. So, for example, if the economy grows, it must also grow physically, physical side of the economy. In other words, supply side, the output must grow as well. In other words, production capacity must grow. Production capacity comes from inevitably, production capacity comes from the physical limit of the plant. In other words, the factory size must increase. Factory size, right? Plant size, production equipment must, also you must have more production equipment, and these things cannot come overnight. right? Growth in the production capacity cannot come overnight. Production capacity to increase your production capacity, you must build additional plant, and it takes the construction takes time, right? Makes sense to build another plant. To double the production capacity, think about it. To double the production capacity, you must double the plant size. And doubling the plant size cannot come overnight. You must, uh, start the construction, right? And the construction takes at least 1 year, 2 years, Um, so the strong demand from good economy uh, 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 the growth in economy increases income, and increased income fuels the demand. The demand is strong, but the supply cannot meet the demand, because for the supply to meet the demand, the production capacity must expand, but the production capacity cannot expand. Like it's not a rubber band. It doesn't stretch overnight like that. Does that make sense? Production capacity cannot stretch overnight. So when the demand is relatively very demand is elastic. Some demands are inelastic, but most of the other than staple goods like food, shelter, clothing, energy, right? Energy is part of the shelter, but transportation, like gas, these are staple, and demand for staple goods are relatively inelastic, but otherwise demand is elastic. So if you have if your income is 10% more than last, or 20% more than last year, your spending will generally go up by 20% as well on average. So and the demand for something like dining out, or demand for something like I don't know what, air conditioner, right? Air conditioner. Demand for something like air purifier, or these days we need air purifier, uh, air disinfector, or whatever. Now, air purifier must be manufactured. I mean, it must be and then the manufacturers of air purifier cannot double the production capacity. The demand for air purifier can double overnight, but their production capacity cannot double overnight. So what happens? Supply is limited. I mean, supply hits the wall, right? But then the demand is still very strong. What happens? It only results in accelerated inflation, high inflation, right? But that's what happened, second half of 1970s, and actually second half of 1970s there was also, not just because of strong demand. It's not because of strong demand, but supply. It was because of the supply shock, more of the supply shock. Why? Because input cost of everything got more expensive. Input cost, because there were several Middle Eastern wars, in the throughout 1970s, and then during these Middle Eastern wars, oil became supply of oil, production of oil was curtailed significantly, and so there was a lot, several oil shocks throughout 1970s, and oil shocks, meaning supply of oil dropped drastically, and then oil is think about it. Would it affect only the energy, heating, and transportation? No, not only heating and transportation. If you think about it, oil is the lifeblood Oil is the lifeblood of all the industries in the 20th century, right? And even in the 21st century, although we are trying to move away from oil to green energy, but think about it, still, a lot of the industry is fueled by oil. Uh, why? Because um, does the air purifier, air conditioner companies must burn oil to produce air conditioners and air purifiers? No, no, no. It's not because of that. Uh, it's because of the power generation, right? Uh, all the production facilities uh, run on electricity, right? And the electricity is produced by what? It's generated by what? Most of the power plants still, especially in the United States, the majority of the power plants are burning fossil fuel, either coal burning or oil, burning oil, right? Um, you might wonder, what about the clean energy? Don't we have a lot of, um, windmills and, hydropower plants, solar power? Uh, yes, we have a lot of them, but the percentage of the power generation in the United States that these, clean energy takes is still small. Still, the majority is, fossil fuel. Power plants, no, majority of the power plants are burning fossil fuel. And it was more in 1970s, right? In the 20th century, the dependence on the fossil fuel for power generation was much greater. So then once the oil price goes up, then what's going to happen? All the, basically, utility bill goes up. Utility bill, right? The power, um, uh, all the plants, manufacturers, their input cost goes up because, basically the energy bill goes up. And then, a cost of production goes up. So everything, there was a huge inflation and very, stagnating growth. And that was like a pervasive, phenomenon throughout the 1970s. So, 1980, as Ronald Reagan came in, and his Federal Reserve Chair was Paul Volcker at the time, and Paul Volcker, implemented tight money policy, tight money policy, meaning uh, uh, reducing the money supply, throughout the economy. And how did they do that? By raising interest rate. I'm gonna get to that why that's related, but so that's why. Um, and they are also talking about tapering these days. What does that mean? Tapering? It's the same thing as basically tight monetary policy. It's another name for tight monetary policy, reducing the money supply to cool off the economy. So, so in 1980s, that was a time. It was when interest rate was like 15%. That was a good time for the savers, but bad time for the economy. So you can tell here. We are a bit ahead, but why then? The question: why does the why is the low interest rate good for the economy, and why is it opposite for first of all, if interest rate is low, first of all, if interest rate is high, if interest rate is high, how easy is it gonna be to borrow money from the bank if interest rate is high? Can anybody tell me? Is it easy to borrow money from the bank can anybody?
No, it's not.
No, it's not. Of course. Of course. If interest rate is high, it's a good thing for the saver, but for the borrower, it's a bad news. Okay, Jodian, I'll give you 0.25 for that. Um, High interest rate is a bad news for the borrowers. But then you might wonder, how is it important? I mean, is borrowing, uh, why do they want to encourage borrowing then? I mean, if high interest rate, they lower the interest rate. If they lower the interest rate, then obviously it's the opposite. If low interest rate is then good for borrowing. It's a good news for borrowing. It will be easier to borrow. So why do they want to stimulate borrowing? Well, first of all, stimulating borrowing. Borrowing here mainly means borrowing by the businesses. Okay, borrowing by the businesses, not borrowing by individuals. Of course, borrowing by individuals, as long as the borrowing increases, that will have a positive feedback effect to the economy. But most of all, if the businesses borrow, they don't borrow to have a party, right? Businesses don't borrow to have fun. They don't borrow to go on a vacation. They don't borrow to have a party. They don't borrow to. And anybody with a good common sense would understand it's a stupid thing, that it's a foolish thing to borrow to have fun. And it will be very difficult to borrow if you say, you go to the bank and ask for a loan. And if they ask, why do you want to borrow? And if you say, well, I want to have a party. I don't think they will, you will have a zero chance of borrowing. It goes without saying. Why? They will only lend to you if you have a potential for generating cash flow, bigger cash flow than the principal that you borrow, so that they can recover their principal and interest. Make sense? So if businesses borrow, first of all, they borrow it for a good reason. They borrow it for expansion of their business, to expand their business, right? Capital is needed to expand their business, and expanding their business means expanding their production capacity. Expanding their production capacity means, basically building new plant. And if they build a new plant, obviously you have to put in new equipment there. So this creates, jobs for the first, it creates a job for the construction company, because the construction project must be carried out by a construction company. And then it creates a job for the production equipment company that makes production equipment, right? Makes sense? It also, once the plant is, completed, then it creates job for new workers, because the new plant must be manned. The new plant must be manned. It creates jobs. As long as it creates jobs, they will spend money. The workers will spend money. Construction company will pay their workers. These workers will spend money. Construction company also spends money, and the manufacturing equipment company will also spend money. They pay their workers. They will spend money, and this feeds back into the economy, right? So there's a positive feedback effect, so the economy grows, right? Is that clear to everyone? So why borrowing is important? Increase in borrowing increases, money supplied throughout the economy, because they spend money. And so it's this diagram. If interest rate goes down, it stimulates borrowing, it increases borrowing, so borrowing goes up, and it leads to an increase in money supply. That means money supply, and then it increases the output of the economy. That Y stands for the income or the output of the economy. Okay, that symbol Y comes from the it's a very old, notation, old symbol. It comes from the physiocracy. Physiocracy is a basically economy, agrarian economy based on land. Because back in 17th century, 16th century, before the industrial revolution of the 19th century, prior to 19th century, the economy mainly depended on the land, the yield of the land, right? It's called physiocracy. Physiocracy means, uh, agrarian-based economy, land-based economy. Because in those days there was no manufacturing, prior to industrial revolution. So the economy of any nation depended on the land, right? Of course. So they wanted to expand their land mass. All the countries waged war on each other for fertile land, and so in those days, France was the main reason France became uh, the superpower of Europe in the prior to 19th century was because France had a massive, among European countries, huge, land mass, and the land was very fertile, right? They had a lot of, yield of the land, right? Land yielded a lot of, produce. So, and then based on that, they could have commerce. They could have, they could raise army, right? You have to feed the army, right? So they could, wage war, to expand the land. Sometimes, the land had, natural gold, because, in those days they didn't have technology to refine the steel, right? I mean, on a massive scale. Gold was additional benefit from the land. Anyway, so now that makes sense, right? Everyone understands, the relation, this inverse relationship. I said, at the earlier, I said, there's an inverse relationship between the economy and the interest rate. So when interest rate goes down, uh, uh, the economic output goes up. When interest rate goes up, the economy goes down. Okay, so that is why the interest rate is so low. And when we say interest rate, oops, what did I do? It is already 11:50, what, 6. So I think this is a good time to take a 10-minute break. So let's take a 10-minute break. It's 11:57, so we're going to come back at 12:07. Okay, 12:07. So let's take a 10-minute break, right? All right, we're back. We're back. So, so let's now think about the classification of interest rates. First of all, as I said, as we already know that the interest rate on the savings account is really, really, almost, derogatory, derogatory, right? It's like, insulting, because it's like not even 0.1%, right? But that's the case when you are, uh, you know, saving your money in the bank. In other words, when you put your money in the bank, is 0.1%. Uh, Regardless, I mean, no matter who you are. You might wonder, does it matter, doesn't matter who I am, in terms of, the interest rate. Uh, well, when you are saving, it doesn't matter who you are. But, when you borrow money, think about it. When you borrow money, it matters. It matters who you are. And who you are is, basically, who you are is measured by your credit score, right? Credit score is, basically individual credit rating. Credit rating is, a broader terminology. Uh, it's not every individual, but businesses. All the businesses have credit rating, basically. All the companies have credit rating. Even the governments have credit rating, right? And you may have heard of, triple A, double A, single A, triple B, double B, single B. What? Uh, these are basically credit ratings for the companies and for the governments, national governments, for sovereign governments. How many of you have heard of, a couple of years ago, after the financial crisis, um, in 2008? I don't know if you were a grown up at the time, or most of you are probably just, in 2008, not even a teenager. So you probably don't remember. But, if you were old enough at the time, you may have heard from the news that uh, the credit rating of the U.S. government fell from, triple A to A minus or something. Is there anyone who ever heard of that, or who remembers that? Is there anyone amongst you, who remember that news headline? Hmm? No, I guess no. Uh, but that was, the U.S. government, credit rating of U.S. government was always triple A, and then it dipped to like triple A minus, not A minus. But regained, and there's and so credit score for personal, for individuals, credit score determines uh, your when you borrow, the interest rate when you borrow money, right? You may have heard of, prime rate. What is prime rate? Prime rate is the rate that is, given to the prime category borrower. Prime category borrower is, or, people with good credit scores, of course. What is a good credit score? Credit score is basically, somewhere between, zero, a number between 0 to 860, I mean, theoretically, it may go up to 900. I don't know exactly what is the upper bound. Uh, my FICO score was, at 1.860. But usually, everyone has credit score between, like 760 and 200 and 760. And if your credit score is above 760, it's considered good. And if your credit score is above 820, it's considered excellent. And it's only about 5% of the U.S. population that fall into that, excellent credit score category. And then, since most of you are young students, I don't know, some of you may be, not just, 18, 19, 20, 21, but some of you may be, 35, or some of you may be, 25 or 20 something. And the younger you are, you have the lower credit score you have. Why? Because you don't have credit history. You don't have long credit history. And just because you're older, it doesn't necessarily mean you have better credit score. But if you're older, you definitely do have longer credit history. But when you are credit score is not the only factor, because when you are borrowing, the most important factor is whether you have an asset or not. For example, if you have a house, $1 million home, right? If you have $1 million home and you have great cars, like you have very expensive cars like Bentley, Porsche, Bentley, Lamborghini, uh, they are uh, uh, they are assets. They can be considered assets. Assets must have income generating power, but your Lamborghini doesn't have, unless you have a rental business, car rental business, and you're renting out a Lamborghini. Your Lamborghini, your personally owned Lamborghini is not an asset, right? Because it doesn't generate income in the business sense of the word. But of course, it can be considered asset from the if you're borrowing money. If you have $1 million home and a Lamborghini and Porsche and Bentley, they can, why? Because they can all be put up as collateral, right? And the banks will be very lenient and generous in lending if you have. I mean, what I'm saying is, they have lenient criteria if you have high asset value that can be turned into a collateral, right? So, but the second factor is your income. If you have a steady, permanent job, and you have, income, steady income, good income, good steady income, of course that increases your credit worthiness. In other words, they are more likely to approve the loan. And also, if you first of all, if you have an asset, of course, asset means they can be put up as collateral, so they can in case you default, they can always foreclose. They can repossess your assets, collaterals. So that's why that's the number one factor. Uh, Second factor is your income. If you have, which can be proven by your tax return. And if you have, for the last 10 years, if you have held a permanent job that paid consistently, good income, good salary, then you're more likely to get approved. Third factor is a credit score, and credit score is purely based on your credit history. Okay, and of course, whether you have assets or whether you have good steady income or not, those that don't affect your credit score. Your credit score is purely based on your credit history. So depending on those factors, right, when you are borrowing, your rate can be as low as like 3.25 to even 12 point something, 18 point something, even 24 point something. The borrowing rate varies. Okay, but here there is something we have to make very clear distinction about borrowing and lending rate. So we can tell there are two types of rates: lending rate and borrowing rate. And the lending and borrowing, this terminology it's determined from the bank's perspective. Bank's perspective, right? From bank standpoint. When you're borrowing, actually the interest rate you have to pay on your borrowing, your loan, is called the lending rate. Lending rate. Why? Because the bank is lending. Bank is the one lending. So it's determined from the bank's perspective. Okay? And so it's the from the industry perspective, right? It's determined whether, and when you are putting your money in the bank, right? That's when you're saving. You earn interest rate, and this is, regardless of your credit score, you get just 0.1% on the savings account. And this is called, borrowing rate, borrowing. And you might wonder, how come? I mean, that means, bank is borrowing, of course, and I didn't lend. I just, you look, you didn't, actively and intentionally lend. You didn't actively or consciously or intentionally lend, and the bank didn't actively, intentionally, or consciously borrowed from you, but you did, and the bank did passively, right? You lended passively money to the bank. That's why you're getting the interest. And the bank passively borrowed money from you, right? Does that make sense? Why it's called, borrowing rate from the bank's perspective. And because, when we say borrow, when we use the word borrow, you unconsciously in your mind, you picture this a situation where you kneel down and beg to borrow. Look, that's it doesn't have to be that way, right? Because you're not borrowing from a mafia. If you're borrowing from mafia, you might have to kneel down and beg to borrow. Please let, right? Please, Don Corleone, please, lend me 10,000. I mean, in the movies like Godfather, they borrow that way. But look, lending and borrowing is just, passive, right? I mean, if you lend money, when you're when you're borrowing money, it's not passive. You have to actively borrow from the bank. You have to meet their criteria. So it's an active, very active behavior, right? Active, conduct if you borrow money from the bank. But, when you lend money to the bank, it's very passive, right? You're passively lending, they're passively borrowing. So now here's the thing. I told you, if they borrow money from, if you put your money in the bank, they will have to pay you like 0.1% interest, at least. right? But then where does that money, if you borrow $1 million, let's say you borrow $1 million from the bank, where does that money come from? It comes from, obviously, it comes from other customers of the bank. It comes from the depositors, right? The savers. And the savers, so they must pay them, if you borrow uh, 1 million, it must come from the savers. 1 million comes from the other savers from the bank. And then if you have a very good credit, excellent credit score, maybe your interest rate could be like 3%. But if you uh, don't have, if you have a derogatory, very bad credit score, then your interest rate may be 15%, right? Or even 20%. Suppose it is 20%. So on $1 million, they get 20%, which will be $200,000. That's a lot already, and a year, right? And then they pay only 0.1% to the uh, other customer who, from whom that $1 million came from, right? 1% of 1 million is 10,000, so 0.1% will be 1,000, right? But then think about it. That's a huge difference between the lending rate and borrowing rate. Isn't that right? That's a huge difference. Huh? It's 20% when they lend, but it's 0.1% when they borrow. There is a difference of 19.9%, and that's called the spread. That difference is called the spread. And this spread is the major source of income for the bank, right? You understand? Banking is, I told you the main business of banking is in lending. It's not in uh, taking deposit, because taking deposit they don't they from taking deposit they don't make any money, but by lending they make a lot of money. So this is that's why there is no difference in lending rate and borrowing rate. So everyone is clear up to this point, right? Everyone is clear about that,
Yes.
right? Okay, good, Jody Ann. How about the other people? Carolis, 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 are you there?
Yeah, I am. Do you hear me?
Okay, so you follow so far? You're
Yes, I
okay
am.
so far? Okay, good.
Yes.
Maricel, are you there? Brandon, okay, following, great. Maricel, are you there, Maricel? Maricel, I guess I lost. Naomi Bruno, are you there? Naomi?
Yes, I'm here.
Okay, do you follow? Do you
I
follow up to that point? Hmm?
I think so.
Okay. Angelica following, Kathleen following. Thank you. Thank you for your response. And who else responded? Let's say, uh, okay. And I would hope, I'm not going to keep asking everyone, but Nikori, yeah, good. Okay. Uh, okay, Jahira, good. Jeremiah, uh, okay. Um, I don't see. How come I don't see? Jahira here. Okay. Um, all righty. Uh, so then, next question is, uh, there's another, classification uh, called, nominal interest rate versus real interest rate. And what is the nominal interest rate? What is the real nominal interest rate? Is basically the stated interest rate. The interest rate, APR that they tell you is stated interest rate. So if you go to the bank and put $10,000 there, and if the interest rate is 10%, um, that means, that's the stated interest rate, right? 10,000. You put $10,000, and 10% interest rate means, 1 year later you will have $11,000 there, isn't it right? That's the stated interest rate. So let's take a look at this, example. I already wrote it down here. So I use I for a symbol for nominal interest rate, nominal. Nominal interest rate is 10%. Pi is the symbol for inflation. Okay, in this thing is not that's not. In microeconomics, pi is the symbol for profit, but in macroeconomics, pi is the symbol for inflation. Let's think about it. So it's already all written all over. So we all know 1 year later we will have $11,000 in your bank account. You will have 11,000, right? So far, everyone follows.
Yes.
However, okay, I don't think there is anything difficult up to this point. Good, Angelica, following. But suppose there has been 20% inflation between between time 0 and time 1. So at time 0 you put 10,000 in the bank. 1 year later at time 1 you will have 11,000 in your bank account, right? And between time 1 and time 0 and time 1 there was 20% inflation. What does that mean? Everything is 20% more expensive, right? Everything is 20% more expensive. So with $11,000, let's say at time 0, which 1 year ago, at time 0, let's say a bottle of Coke was $1. A bottle of Coke was $1. So with $10,000, you could buy how many bottles of Coke a year ago? With $10,000, how many Coke could you buy?
10,000.
10,000. Yes, 10,000. Who gave me that answer? 10,000. I heard two voices.
Jody
Who gave me that? Jody and the gentleman was who? Jeremiah?
Yes.
Was it Jeremiah? Okay.
Yes.
Okay. So Jodian, you got another 2.5. And Jeremiah, you got 0.25. Yeah. A year ago, with $10,000, you could buy 10,000 bottles of Coke, right? And if there has been no inflation, if there was no inflation, right? With $11,000, not 11, but yeah, 11,000. You have $11,000 now. So 1 year later, at time 1, you have $11,000. With $11,000, if there has been no inflation, with $11,000, how many bottles of Coke can you buy now?
11,000.
11,000.
11,000. 11,000. Once again, it's Jody and Jeremiah again. So, okay, this is a very easy question. So I will give I will give you 0.25 for answering my question. 0.25. Both of you got 0.25. But there has been 20% inflation. That means what is the price of Coke now? Hmm?
$1.20.
Yes, $1.20. And is that Jodian?
Yes.
Only Jodian. So Jodian, you got another 0.25. So today alone, you got extra 1 point for that. Nikuri, yeah, you typed in. Thank you, Nikuri, but that was after. You should have been faster, or you should have used your microphone because that was after Jodian already gave the answer. So I cannot award that extra point. Uh, so please use your microphone. Uh, Yeah, a Coke is now $1.20 because of 20% inflation. Then think about it. How many real you have $11,000 now? Nominally, that's nominally $11,000. But in real terms, meaning in other words, how many bottles of Coke can you buy now? With $11,000, how many bottles of Coke can you buy now?
10,000 bottles of Coke.
Like
10,000?
9,100 something.
Yeah, 9,100 something. Who was that?
Uh,
Who was that?
I got
Hmm?
8,800.
No,
Jeremiah.
no, no.
No,
Who
it's
gave me 9,100?
Me. Jeremiah.
Who is me? How do I know it's me?
Jeremiah. Jeremiah.
Jeremiah. Okay. Jeremiah, I will give you 0.25. Okay, please give me your name because I wouldn't know. Yeah, how? Of course, you will have to divide, right? What you need to do is you will need to divide 11,000, right? 11K by $1.20, right? $1.20, right? And if you do that, you will get like 9,000, 1,600, 9,100 what am I? Yeah,
I got
9,167.
9,166.
Yeah, 9,001. That was eraser. So
66.
9,166. Yeah, 0.67. Of course, you cannot buy, but we'll keep the decimals because uh, I mean you cannot buy 0.67 bottles, right? You cannot buy. So we'll need to round it up to uh,
nine.
or round it off to 1,000, 9,166 fall. So what does that mean in terms of due to inflation? Although nominally you have $11,000, that's nominal, right? Uh, Nominally $11,000, but in real goods, you can have only 9,166 bottles of Coke, right? That's the concept of real dollars. The purchasing power of the $11,000 is only 9,166 bottles of Coke. So the purchasing power of your $11,000 is actually lower, smaller than $10,000 a year ago, right? Does that make sense?
Yes.
Everyone, right? Yeah. So that is, That is, what is meant by real. Uh, real, and let's think about it. Um, if we find, so 20%, when we divide this number by dollars, because you divide dollars by dollar, what came out is, number of units, right? Number of Coke. But let's do the same thing. If I adjust, so that means the purchasing power of 11,000 nominal dollars, right? If you adjust it for inflation, inflation was 20%, so 1 plus pi is 1.2. If you adjust it for inflation, and adjusting for inflation is not just dividing, it's not dividing by 20%, it's not dividing by 0.2, because think about it, if you divide something by a number that is between 0 and 1, it will be much bigger, right? That's no. Um, uh, you came to this is the gross inflation. Gross inflation alone, net inflation is 20%, but the gross inflation is 1.2. In other words, Coke price of Coke became the price of Coke became $1.20 because it grew by 20%. You understand? So $1.20 is $1 times 1.2. Isn't that right? So basically, that one is the original price itself, right? So so the gross inflation is 1.2. So if you divide it by gross inflation, then this will come out as dollars, and the dollars will in terms of, so this is the real dollars, not nominal dollars, meaning this is the purchasing power of $11,000. In other words, this is what you can buy actually in real goods, in real terms, is just like the purchasing power of $11,000 in terms of real goods is only equivalent to $9,166.67 before inflation, right? That's just what $9,166 could buy before inflation, right? So after adjusting for inflation, then it's called, real, right? So interest rate is also, we can make adjustment for inflation. As I said, I stands for nominal interest rate, and nominal interest rate is real interest rate plus inflation, right? Just like real Coke, right? And the nominal what you can what nominal $11,000 can buy in terms of a real goods, right? So you can, so that means real interest rate is nominal interest rate minus inflation, right? So this is very important concept. What real interest rate means is a very important concept. We're almost already out of time, but let's think about it. So then real and because these are already percentage, right? They are all percentage. You can subtract between add and subtract between percentages, but if it is not percentage, you cannot do that. So what would be the real interest rate? Anyone? This is your last bonus point of the day. What is the real interest rate? Nominal rate was 10%. Inflation was 20%. So what is the real interest rate in this case? Anyone?
10%.
10%? How can it be 10%?
Minus 10%.
Yeah, negative 10%, negative 10%. And who gave me that?
Jodianne.
Jodianne again. Julian, you racked up a lot of points already. So you got another 0.25. So yes, it's negative 10%. So that means real interest, negative 10% real interest rate, right? What does negative interest rate mean then? Our question is then, how can you have a negative interest rate? It's like now think about it. Negative real interest rate means when you put your money, when you put your $10,000 in the bank at 10% nominal interest rate, um, and so 1 year later you will have 11,000, but the inflation was 20%, right? That means in real purchasing power, nominal 11,000 is only worth 9,166. So you actually lost money. And that means as a lender, you lender should be paid interest, isn't that right? If you're a lender, a borrower should pay you interest. So the bank should pay you interest. Bank paid you interest, 10% nominal interest rate, nominal interest. But in reality, you paid the bank, you paid the borrower interest of 10%. Does that make sense? Because inflation ate away. Inflation ate away the purchasing power by 20%. So you effectively, although you got $11,000 back, right? You got $11,000 back, but in terms of purchasing power, it is only worth 9,166. So you effectively paid 10% interest to the borrower. You're the lender, but you paid interest to the borrower. Think about it. You gave the borrower, you paid the difference between 10K and this, which is like 800 something. You paid interest of 800 something to the borrower, actually, if you think about it. Does that make sense? Everyone?
Yes.
Okay, so that's the meaning of real interest rate. Then why is this important? We are out of time already, so we'll continue to talk about this. But this is the food for thought. Why is this important? Why the real interest rate concept of real interest rate is important? We'll talk about. So next in the next class, this is your food for thought, and to those who give me the correct answer, there will be a bonus point, of course. All right. So we are I will see you this Thursday. It's another holiday, so please check the holiday schedule. I posted in the. So the next time we will meet, it will be next Tuesday. Okay. All right, everyone.
Okay,
All
bye.
right.
Have a good one.
All right. Take care,
Have a good day,
everyone, and I will see you
Professor.
guys
Bye.
next. All right. Take care. Take care. Stop recording.